Welcome back to another edition of Sunday School with your boy Buck Bandit P here on the Financial Corner, where we break down investing for average everyday people so we can go out here and get this money, you hear me? But before we get into it, make sure you like the video, make sure you subscribe to the channel, and also, if you don't have a brokerage account, if you don't have a stock account, don't worry about it, I got you covered. You get a free share when you open up a brokerage account with Robinhood, man. So you can get off the sideline and start printing some of this money with us. Also, if you don't have your high yield savings account, make sure you click the link down below. Get a free $100 when you open up your high yield savings account with Allah. So without further ado, got a lot to talk about today. So let's get right into it, all right? The index fund revolution. You hear me? The index fund revolution. That's what I'm calling this episode. Episode 16 of Sunday School, all right? So why invest in index funds, P? That's what people gonna ask me. Well, why should I invest in the index fund? Because the index fund is going to give you exposure to the whole market versus just one company. Index fund is like a grocery store, all right? Like an index fund is buying the whole grocery store. You're gonna buy the whole ShopRite, the whole Publix, the whole Whole Foods. You're gonna buy the whole store. That's the index fund. Individual stock is a particular product in the market, okay? So that's gonna be way more riskier than just buying the whole market. And the ETF is, and I got this from, I don't know if it was from Wall Street Trapper or Troy and Rashad. I don't know which one. It might have been Wall Street Trapper on Earn Your Leisure. It might have been that. I don't know, but I heard this from either of them. ETF is like a specific owl in the market. So an ETF is going to cover a specific sector, and I'm gonna get into the different sectors of the market too. Why invest in index funds? Because it's going to give you exposure to the whole market. Like, and you don't have to focus on doing your research just for one particular stock or one particular sector. Let's talk about the risk of the index funds. Is way less riskier than buying an individual stock, like I just went over, because even a lot of professional investors get this wrong. They put all their money in one stock, or they bet on one stock and that stock end up going nowhere, end up sinking, end up going bankrupt and out of business, and people left holding the bag. That's why index funds are riskier. I said that in my income versus investing video. Go make sure y'all go back and watch that income versus investing video, because I explain how you definitely gonna have a more upside investing, but you can invest easily. Like, you don't have to do all of this research and study charts and be this magnificent Warren Buffett type of investor to retire with millions of dollars. Just buy index funds, work your job, do your match with your pension, and over 40 years, if you're just doing that, most likely you're gonna retire with $1 million net worth easily if you do that over 40 years. But a lot of people wanna complicate it. Oh, I wanna invest in this individual stock. Oh, I wanna day trade, or I wanna leave my job and be an entrepreneur. Now you adding a whole bunch of stuff to the equation, and it's gonna actually take you longer to get there. Like, the safe and steady way to invest, like stress-free, kick your feet up, relax in the sun when you retire, is just invest in index funds and ETFs. And I'm gonna get into it. There's sectors in the stock market. I never went over this on my channel, so I need to break this down for y'all, because a lot of people think it's just tech, or it's just this, or it's just that. No, the market is broke down into sectors. It's 11 sectors, so let's get into it. We got your information technology. That's your companies like your Apple, your Microsoft, your Nvidias, and your Googles. Everybody know them. We don't got to talk about what they do. We got your healthcare. We got your Johnson & Johnson, your United Health. We got your CVS. Like, those we already know. Like, that's simple. People know them, but they probably just don't know the sectors. So that's information technology. That's healthcare. Then we get into financials. We got your JP Morgan Chase. We got your Goldman Sachs. We got your Bank of America, stuff like that. That's your financials. We got consumer discretionary. That's your Amazon. That's your Tesla. That's your Home Depot. That's your McDonald's. Then we got communication services. That's your Google. That's your Meta. That's your Netflix. Then we have industrials. That's your Caterpillar, your GE Aerospace, RTX Corporation, your Boeing. Then we got consumer staples. That's your Walmart, your Costco's, Procter & Gamble, Coca-Cola. Then we got energy. We got Exxon. We got Chevron. We got Shell. Then we got your real estate, your REITs. We got O Realty, American Towers, Prologis. We got Simon Property Group. These next sectors, a lot of people don't know about these next couple sectors. So I'm gonna get more in depth with a couple of these companies. We got materials, that's your next sector. And we got a company called Southern Copper. We know what they do. That's a good company. You might want to check them out. Ticker symbol SCCO. We got a company called Linde. Ticker symbol LLIN. And they the big dog of the industrial gas space. Okay, so you thinking hydrogen, oxygen for hospitals and factories. All right. And also what's good about Linde is they are a dividend aristocrat. And all a dividend aristocrat means is they raise their dividend every year for decades, for I think 10 or maybe 20 years. So that what makes you a dividend aristocrat. You raise your dividend every year for over 10 or 20 year period. So that's a good company to invest in. And also Sherwin-Williams, we know what they do. If you paint your house, if you a construction out there, you know what Sherwin-Williams is. So that's your materials sector. Then we got your utilities sector. We got NextEra Energy, ticker symbol NEE. They focus on renewable energy and clean power. We got Constellation Energy, ticker symbol CEG. That's a top U.S. producer of carbon-free energy. And they focus on nuclear and renewable power. And also we got Duke Energy. This is one of the ticker symbol DUK. This is one of the largest electric power holding companies in the U.S. I just gave y'all some game. Y'all might want to go check these companies out and do your research. These are solid companies. Quiet, boring companies a lot of people don't know about. You don't hear none of your internet gurus talking about these, but this is where the wealth is made because wealth is boring. So, what is an index fund? I already went over it, but let's go into it a little more. It's basically like a basket of stocks. So, instead of buying one apple and hoping it don't rot, you just buy the whole apple orchard, okay? So you cover your downside and you get a better upside, more stability. The S&P 500, this is the best 500 companies in the U.S. Everybody talk about the S&P, SPY is the ticker symbol. You could go buy this. You invest in that, 20 years, most likely you're going to be good. Why does this work? Is because it's survival of the fittest. The thing about the index is when a company start underperforming, the index automatically kick them out and they bring in the next rising star. So it's like a team. So instead of putting all your money on one player, you buy the whole team. And then when you buy the whole team, you don't got to worry about, oh man, this player ain't doing nothing. Who should I trade him for? This, that. The company already gonna do that for you. So, you know what I mean? They gonna get rid of that underperforming stock and bring in a new stock that's gonna put some numbers on the board. That's how you just gotta look at it for all my sports fans out there. Just the thing about index funds, even though they do the work for you, you don't gotta worry about balance sheets, none of that. The index manages itself. You still gotta pay that cost of doing business. Nothing is free out here. You gotta understand active versus passive funds. Active funds do a lot more moving and shaking. They trying to really outpace the market. Passive fund, it's just chilling. They ain't doing too much moving around unless something start underperforming, then they'll replace it. But the difference between active and passive funds is the fees. Fees are important. Passive funds usually range from like 0.5% all the way down to 0.1%. So 0.1% all the way up to 0.5%. Active funds usually range from like 0.5% to sometimes over 1%. But this is like the sneaky leak. This is like the slow leak because over a lifetime, over your investing lifetime, this could equal thousands of dollars of gains. So you want to make sure that you doing your homework when you investing in these funds so you don't get hit with all these fees and it eat into your profits in the future. And I got some homework for y'all. Be careful of the high management fees because they can drain your portfolio 20% over a lifetime, all right? So index funds are like the budget-friendly way to get rich because you investing carefree, but you still keeping them fees low. In closing, this is the homework. From now on in Sunday school, y'all gonna have some homework because y'all be being lazy out there and I need y'all to do some homework and do some research so y'all can understand this stuff even more. And it's really simple. It ain't nothing but a search away. Shit, chat GPT, nigga. So The action item, look up the expense ratio for one fund that you are interested in, all right? And if it's over 0.5%, then ask yourself why. That's all I want you to do. That's your homework. You're going to look at a fund that you think about investing in, that you're interested in, and I want you to look up what is the expense ratio, all right? And then ask yourself why. Once you see the expense ratio, you should already know when I told you about passive funds and active funds. All the expense ratio is what that fund is going to charge you every year for investing for you. That's all the expense ratio is. What that fund is going to charge you every year on that money for investing that money for you. So if you got $10,000 in this fund and they charge 0.5%, then what's that, like $50 or something every year or something? So that's how you can see, all right, how much am I paying for them to invest my money? That's the homework. And that is the class. If this helped you, make sure you do one thing for me, y'all. Make sure you share it with somebody who need to hear it, who it can help them too, so this stuff can stop seeming so complicated and we can realize it's really as easy as bada bing, bada boom. You understand me? With that, class is dismissed. I'll see y'all next week, and let's go out here and get this money.